Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my daily comment for Tuesday, December 22nd. Now that all the major pronouncements that we've been expecting are out of the way, the question we have to address is, what's next for the Fed? I expect that there will be a period of waiting and watching while the FOMC members assess whether inflation is going to reach their target. If they decide it is, then they'll tighten further and the dollar will appreciate. If not, then we may have reached almost a maximum for the policy divergence, and the dollar could weaken. Now, Fed Chair Yellen spelled out in broad terms the conditions necessary for further tightening in her opening remarks at the press conference following the recent FOMC meeting. She said the committee would proceed gradually, and that moves will obviously depend on how the economy evolves. In other words, we can't expect a rate hike at each meeting. Rather, they'll have to make a fresh decision each time. Now, as you probably know, the Fed has a dual mandate. They're required to pursue maximum employment and stable prices. They've effectively met their goal for employment, but stable prices remain far away. They define stable prices as a 2% year-on-year rise in the personal consumption expenditure deflator. But it's up only a tiny 0.2% year-on-year. Even the core index, which excludes food and energy, is up only 1.3%. Still far away from their goal. That means progress on inflation will determine whether they hike or not. The inflation data may therefore supplant the monthly non-farm payrolls as the key indicator for the markets. If that's the case, then the market's bound to be nervous around each announcement, because so far, the signs for higher inflation aren't really there. First off, the U.S. economy seems to be slowing somewhat, according to the recent PMI data. That means there's little upward pressure on inflation. Secondly, inflation has been surprising the markets on the downside recently, not the upside. Could it surprise the Fed on the downside over the next few months too? Yellen said one of the main reasons inflation isn't hitting their target is because of the fall in oil prices, the effects of which, she said, quote, should dissipate over time, unquote. Now, it's true that oil prices aren't going to zero, but prices haven't shown any sign of bottoming yet. Moreover, gasoline prices haven't fallen as much as oil prices have, meaning that there's still room for the fall in oil to feed through to the consumer. Against this background, the monthly personal consumption expenditure, PCE deflator, the Fed's main target, becomes a much more important indicator than before. The figure for November will be released on Wednesday, tomorrow. As I mentioned, it's still far, far below target. We'll have to see it rise before they can hike again. In short, I expect a period of stability on the FOMC. I don't see any chance of another rate hike at the January meeting. I think the earliest would be the next meeting after that, in March. I still believe that the committee wants to raise rates further in order to normalize their monetary policy, but they need to move within the context of their mandate. That means they'll be watching the inflation numbers carefully, and so should we. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.